Obviously, the main component is you got to figure out who's going to lend you the biggest chunk of money. The first thing that I want to figure out is, what are you more sensitive to? Are you sensitive to payments, like or are you more sensitive to the total cost of the land?
It's not like hard money though.
No, it's different. Hard money is very mercenary. That's mercenary money, right?
Right.
This is Maestro Minute, the show that discusses all things real estate, sharing interviews with the most successful people in the industry. Hear from their perspective and what they are doing to achieve success. Get exclusive tips on how you can also succeed in real estate. Maestro Minute is brought to you by Maestro Development. Here's your host, Nareg Muradian.
So you're heavily into the capital side. What are some other financing methods in development?
So for development, listen, when you're doing any kind of real estate, especially commercial real estate or a development where, you're dealing with high finance. Obviously, the main component is you got to figure out who's going to lend you the biggest chunk of money. Is it going to be a bank? Is it going to be a private investor? Is it going to be you're funding it through partners? Maybe you're funding it with somebody else. Like, what's that base chunk going to be? The bottom 30, 50%, right? And then beyond that, then you start filling in the gaps to get the rest of the money, whether it's for the down payment, whether it's for what we call CapEx or the capital costs, construction costs, things like that are on top of.
So your first deal was your grandfather gave you the loan, right? So family loan.
No, actually that first chunk was the owner. She gave me a senior loan, like first loan. And then my grandfather gave me the down payment.
So she gave you the loan with capital she already had.
She owned the land outright. She just said, I'll give you the loan. She created a note. And I was just making payments.
I see.
Right?
What was did she give you like a rate?
I think it was somewhere above 8% probably.
I see.
It was amortized over a long period of time. The great thing about like finance and notes, you can adjust one thing in order to have an outcome. So if you and I are talking, like, I want to buy this car or I want to buy this piece of property or whatever, the first thing that I want to figure out is, what are you more sensitive to? Are you sensitive to payments, like what or are you more sensitive to the total cost of the land? Mm-hmm. To me, it was the payments. I wanted as little payment as possible. So she set up something where it was like, okay, well then we won't do a 5-year note. We're going to do a 30-year note in order to get the payment down. But you're going to be on the hook for 30 years, paying $350 a month.
Was she eager to get the land sold?
I don't know.
What was the driving force for her?
I think this is what she did. I think that she owned a few pieces of land.
I see.
And she wasn't doing anything with it. And she's like, okay, let's sell on owner financing. And if somebody fails, I'll just take it back.
Oh, wow. I find from my experience that the owners feel like their land or their assets are worth more than what the market value is, right? And obviously it depends on where the economy is, right?
Yeah.
What's the seller's, buyer's market? It just depends. But what other types of creative financing do you guys use?
Right now, we're like with my company, Prosperity CRE, we're very straight down the middle in terms of how we put together the initial financing. So we use agency debt, we use Fannie Mae, Freddie Mac, stuff that's going to be bonded up. We get creative when we raise capital from investors. So when we're thinking about development, one of the things that we've been really exploring right now, aside from money from our investors, because the money from our investors is expensive, right? We might be able to get 6% debt on the initial piece from Freddie and Fannie, but then our investors, we have to pay them 13, 14, 15, percent or higher. So how do we find cheaper debt and to try to take away some of that more expensive money? And so there's a thing that's out there right now called C-PACE financing. I forget what the acronym means, but it's a type of financing that will fill in the gaps where it allows you to pay for capital things like your HVAC, right? Or maybe some roofs or, big ticket items. And instead of it being a loan that is secured by a trust deed, like a bank loan, it's actually secured with the property taxes. And whenever you pay your property
Okay.
taxes, you're paying, you pay a chunk of that payment, right? If something happens, they're not going to foreclose on the property. It runs with the land until that property is paid off.
Got it.
It's a very
Okay.
innovative kind of way of financing. It doesn't work for all properties, but for development, redevelopment, heavy value add kind of stuff where you have
Yeah.
big things you have to pay for and you don't have the money for it.
Yeah.
C-PACE is something that's coming on really, really strong right now.
Is that product available from like major mainstream banks, or is that like where do
Yeah.
you find that?
Yeah. So actually, that's a good question. I feel like I've heard of some big players doing it, but it's not a product that you're going to get like a regular senior loan. It might be a company that a big bank had purchased and they just have that financing company, or they're
see.
funding, their table.
I see.
Table funding it.
I see. It's not like hard money though.
No. It's different. Hard money is very mercenary. That's mercenary money, right?
Right.
You're gonna get a trust deed because that's the safest. That's the safest kind of security you can get in a property,
Yeah.
right? They're gonna try to get a first trust deed, right? Sometimes they'll do seconds, but you're gonna pay for it, and they're only gonna do up to a certain loan to value,
Yeah.
And if you want more, they're gonna say, well, what other properties do you have? We'll securitize those. So now you have to put your house up as collateral, or your second house, or your kids BMW or whatever.
Or the kid itself,
Or
right?
your kid, you put your kid up.
Collateral, sorry.
Oh, absolutely.
Number 4,
If I can get a
you're,
trust deed on my kid, forget it.
his future earnings.
Totally. Right. So owner financing, within the owner financing sphere, there's ways of, like, lease to own is a really creative. I'm talking about single family houses, duplexes, stuff like that. Lease to own is a very creative way to do owner financing, and then after a period of time, be able to purchase the property, right, without having to qualify in the same way as a bank.
That's pretty interesting. So there are different products out there that you guys are using. What's the majority of type of assets you guys are looking at right now?
So right now we're strictly multifamily. We have background in industrial, flex properties, a little bit of office, but mainly it's multifamily. And within the multifamily space, we are pretty strictly in the garden style multifamily. So garden style is the large apartment buildings, 100 units plus, usually with a lot of trees, big parking lots. You'll see they're like broken up by buildings that are maybe 2-3 stories tall, not elevators. They have breezeways, exterior doors, some balconies, things like that.
So no elevators because of the
elevators.
infrastructure, or
Yeah. Typically, it adds a component to the type of property where you don't necessarily need it if you have space.
Thanks for tuning in to the Maestro Minute podcast. Make sure to rate this podcast if you found it helpful, share it with a friend that could use it, and follow us on all major podcast platforms. The Maestro Minute, powered by Maestro Development.